Hey guys, my name's Zara. This is RozarasInvestments. So today is Friday. The market has been dropping like crazy on Wednesday and Thursday. So I thought I'd make a list of 13 stocks that I both bought recently and plan to buy more of either today or Monday. So I was lucky enough to sell about $9,500 of a mutual fund last week when the market was at the high. I saw all the commentators on CNBC. They were all super happy. So I thought that was probably a time to sell a portion of my mutual fund. So I sold $9,500 worth. So I have that money to spend. I also got my monthly bonus from selling cars for September. So I have that money to spend. So I have about $12,000 to put into new stocks. And I love investing. That's what I'm excited to do. So here's my list. I got 13 of them for you. I talked about PayPal before, market cap $89 billion, one of the bigger stocks on the list with a PE ratio of 45, which means it's making actual money. Divide that out, that's about $2 billion a year that PayPal is making. This company is growing in the 20% ballpark. It is a very good company that I use, that a lot of people use. They have a new partnership with Walmart. On November 18th, they are expected to earn about 54 cents a share or more. If anyone doesn't know, it's a tech platform for digital payments. It's very, very easy to use. They used to work with eBay. Now eBay is a very small portion of their business. And that leads us to the second stock on my list, in no particular order, eBay. This doesn't have a PE ratio, but intuitively, the PE ratio is pretty low. A lot of times it doesn't have a PE ratio for tax or accounting purposes. Just so you guys know, I quickly, just to make a list really quick, I got my PE ratios off of the Robinhood app. So take that for what it's worth. I don't know if they're 100% accurate or the type of earnings that you'd be looking for. But just to save time, I get the info from the Robinhood app. So on October 30th, eBay is expected to report about 55 cents or more. It's a commerce company, similar to Amazon, except for they sell stuff online, and I'm sorry, I phrased that wrong. They don't sell stuff online. They take a portion of the money from people that do sell stuff online. They're a platform for other people to sell, for buyers and sellers to meet. So anyway, everyone knows what eBay is anyway, whatever. I don't have to explain it. Just going along the lines of the stocks people know, about half of them you know, and half of them you probably won't know. Square is another company that you probably know. It's a credit card payment processing solutions company. You take a credit card, you swipe it, and on a little thingamajig on the top of someone's phone, and regular people like me can accept credit cards if you're selling books, or you're selling sneakers, or you're selling whatever. So Square is expected to report November 6th. They're expected to report 7 cents, and currently it is also the same exact market cap as eBay, $31 billion. This one doesn't have a PE ratio because they don't earn money yet. But Square has been one of the fastest growing companies. It recently hit about $100 a share, and over the last couple days, it's down to, like, if memory serves me right, like $69 a share. They've taken a big dip, so I think it might be time to carefully buy some more shares. And when I say carefully, I mean I'm not going to go and invest $5,000 all at once into Square, but buying a couple $100 worth of shares I don't think would hurt. And then that way, when you do something like that, you don't really care if the stock goes down because you don't have like too much money invested. But if it does go up, you're happy that you'd at least invested something. So yeah, on to the next one. This one, a lot of people are probably familiar with by now, ROKU. And I love companies that have their symbol is the same as their name, so ROKU. Also, November 6th, they're expected to report negative 9 cents. Some of these expectations are mine because no analysts gave their expectation on Robinhood. So I'm just giving you my own expectation. They're expected to lose 9 cents. And they probably should do better than that because they're also a fast-growing company, revenue-wise. The market cap is about $5 billion. And by the way, when I say the market caps in this video, everything is truncated to the nearest billion. So when I say 5 billion, it's at least 5 billion. So anyway, it's a streaming platform for TV. Anyone that owns a Roku TV gets a little remote and they can quickly go to the main screen and switch between YouTube or Netflix or cable TV or their Amazon Fire Stick, or whatever they want to switch to. So Roku just makes everything easy. That whatever you want to stream, you can stream nice and easy. So Roku has been kind of a fast-growing stock and in the news a lot in the last year. So I think I want to own some shares of Roku. I own a couple shares. I'm planning on buying a couple more now that the price has dipped. Let's see, on the list, maybe the last one that everyone knows is Ford. Ford is a $35 billion company that makes trucks. The best-selling vehicle in America is the Ford F-150. It's not Toyota, it's not Honda, it's not Chevy. But Ford has a PE ratio of about 5 right now, meaning they're making about $7 billion a year, but the stock is only $35 billion. It's very hard to compare a company like Ford to a company like Tesla that doesn't make money. It's kind of ridiculous, and to guess which one is going to have a bigger market cap 10 years from now, it's kind of hard to guess, because Ford is already very successful selling their Ford F-150 trucks. They make a lot of money, and Tesla has a very bright future ahead of it, but they make zero money right now. So who knows? Invest in what you want, but the reason I invested in Ford is because they currently pay about a 6% dividend yield, which is absolutely amazing. Their shares, last time I checked, were $8.88. Dropped down from about 15 bucks a few years ago. All right, let's speed this up a little bit. Adobe, you guys might know Adobe, digital marketing and media. It is another big company, bigger than PayPal. It's $116 billion with a PE ratio of 49, which is still a high PE ratio, but this company is growing revenue and earnings very, very quickly. Adobe is expected to report on December 12th, so a couple months from now, and I'm guessing $1.25 or more. Because they're a growing company, they're expected to surprise to the upside. Let's see. Blackline. Blackline is a company that I don't know much about. I only bought a couple shares. Financial automation, software and solutions to the SAP market. This is only a $2 billion company, so very small, one of the smallest companies on my list. So this company does not have positive earnings right now, but the reason I bought it is because the revenue growth is so strong. It is a relatively new company, and I think by speculating and investing in some of these types of companies that are very, very fast revenue growers, which means that they're selling lots of stuff. They're selling more and more stuff every year. This means customers really want their products. So I think it's very important to invest in these type of companies, because by investing in the companies that are growing their revenue, the small companies that are growing revenue very, very quickly, like 30, 40, 50, 60%, this is the way to double and triple your money in some stocks. These companies are often far less analyzed. All right. Appfolio, APPF. APPF. Also has a $2 billion market cap. They do earn money. The PE ratio is very high, 125 times earnings. Let's see, on November 4th, they're expected to report about 11 cents. They are a cloud-based software solutions. I bought this at the exact same time as I bought Blackline. Also a company I'm not too familiar with. I'm taking my chances, very fast revenue grower. Now, Paycom is next, a $7 billion company, symbol PAYC. They are a $7 billion company with 71 PE ratio, so still on the high side, but it's a very small company, and they have a lot of potential. Cloud-based data analytics. A lot of stuff that has the word cloud in it. It just seems to do good. I don't know too much about this company, but from a technical analysis point of view, this company is very, very good. I decided to dabble, buy a couple of shares, and I plan to buy a couple more after the recent downturn. Axon makes electric weapons and wearables. The symbol is AAXN. Let's see, it's a very small company, $3 billion, but the chart looks very good. They're definitely on an upward trend over the last couple of years. Very high PE ratio at 156. Relatively, they don't earn a lot of money compared to their market cap, but they are a growing company. They're growing earnings, growing revenue very, very nicely. So I dipped my toes into that one. Which one haven't I talked about? Health Equity, HQY. This company is in the business of healthcare savings solutions. They're expected to report, let's see, on December 3rd, they're expected to report 18 cents. That's my guess. This is a $5 billion company, so still kind of considered a small cap, maybe a medium cap. They are earning money. The PE ratio is around 84. And I just invested in this smaller company because it is a relatively new company that's growing revenue, growing earnings, and this is the type of company that can double or triple in the next few years. I'm not super afraid to pay up for a company, pay up for companies that are really growing. So even though this one has an 84 PE ratio, I think that because their earnings and revenue are growing so quickly, you know, this might be the type of company that would double and triple. You know, they could double their earnings in just a couple of years, and then that PE ratio, if the stock didn't move, would drop to 42, which is still on the high side. But you know, usually if a company's growth is you know, really going strong, the price stays high. And kind of proof of that, a company that's already a little bit bigger, and I didn't write it on the list, but just off the top of my head, is Align Technology. And they have a PE ratio of about 85. And for the last few years, their PE ratio, they're the company that make the braces, their PE ratio has been consistently in the 80 to 110 range. And that's because they're always growing earnings and revenue by like 40% every year. And it's very consistent, it's very predictable. So as long as a company can continue to be consistent, predictable growth, get those earnings up, get that revenue number up, they can sustain a high PE ratio. So starting to be less afraid of investing in companies that I view as expensive, because there are many other ways of valuing companies. Let's see, HubSpot, a cloud-based marketing and sales company. HubSpot, the symbol is HUBS. This is a $4 billion company that does not earn money yet, but they are expected to report pretty soon. Let's see, October 31st, they are expected to report, well, I'm guessing 3 cents. So hopefully this company can go from not earning money to earning money this year. So we'll see about that. I only invested a little bit. I dipped my toes in the water. And moving on, the last company on the list, NextEra, NEE, which is an energy company. This is a big company, $81 billion market cap, and only 9 times earnings. So if you look at the chart of this company, it's up over the last 5 years. I bought some shares. I haven't been disappointed. They do pay a dividend. I just wish I put all my money into NextEra and you know, just forget about everything else in life. I'd be a millionaire now. But I didn't. I did buy a couple shares though, so I made some money. This company is expected to report relatively soon. What is it, in 10 days or so? October 23rd, they're expected to report $2.13. So relative to their share price, this company is earning a lot of money. They're growing, and it seems like the share price hasn't caught up with the amount of money that they're earning. So this one's definitely on an upward trajectory. So I will write all the symbols in the description. I will put the link to my Robinhood if you want to get that free share. I'm not pushing it on you guys. This isn't a sales pitch, but I'm just telling you stuff that I buy for myself. And if you want to further look into some companies that are really growing, except for Ford. Ford, I wouldn't consider a growth company, but the other ones are growing, and the other ones I have bought shares of, and I'm going to buy more shares of with my money that I haven't invested yet. So anyway, thanks for watching. Thanks for subscribing. Thanks for sharing. It really helps me a lot when you subscribe and watch these videos. Hit that thumbs up button, and I will see you next time. Bye.